Talked about those levels in 10-year yields, amazing. 2 Mondays ago, 5%. We're going higher.
Exactly.
Here we are, 465. Have we seen the highs in this Treasury market?
I would argue yes. I think if you look at the move in the last month or so, it's been a very technical-driven move. Once we broke that 430, 440 level, it was, a lot of essentially short positions being put on. This narrative built that there's no demand out there for Treasuries. What we saw this week was we saw some softer data. We saw the Treasury essentially responding to the move. The Treasury actually cut back some of that long-end supply. And we heard from the Fed that the bar to hike further is high. This vigilance and caution from the Fed, they're sort of bringing up this whole lag story back again. So they're waiting for the long and variable lags to play. So I think for us to break 5%, we really need that narrative to come back that there's no demand. I would argue the highs are set. How low can the 10-year go is all going to depend on how does the economy, fare in terms of those lags essentially coming back.
And link it to the 2-year, the vanilla spread, the difference in yield between the 10-year and the 2-year. You more than anyone called the magnitude of inversion you would see. Where are we now? Have we disinverted to where Priya Misra says this is wonderful, or do we need to disinvert more and even go to a positive difference between the 10-year and the 2-year?
I think for it to be really positive, it has to be driven by lower rates. And that's going to need the economy to show signs that, that monetary policy is extremely restrictive. I think that's what results in the next 100 basis points of steepening will be through lower rates. But I'm glad you bring up the 2-year. I mean, all this talk about the market pricing in significant cuts, we're only pricing in 125, 130 basis points of cuts. So what the market's telling you is that they're pricing some easing, so which would be consistent with a soft landing. The market is not at all pricing in the risk of a hard landing. I would argue it's 10%, 15% chance, this bimodal world, that there's a very small percent chance of a hard landing, because in that scenario, the Fed is not just stopping at 4%. And what the Fed funds curve is telling you, that the market's pricing in the Fed funds rate to be above 4% as far as the eye can see. That's essentially what the bond market's telling you. No hard landing, that the Fed's going to never cut rates below 4%. I think that's highly optimistic. If you look at the tightening in financial conditions, you look at the cracks that are developing, I think there's a decent chance that the Fed may have to cut a lot more. They don't want to acknowledge it. They're not even thinking about cutting rates. At some point, they're going to have to acknowledge that they may have gone too far.